What's up, everyone? Dylan here. I wanted to hop on for another episode of the weekly analysis video. This week will be a shortened holiday week, as Friday the markets will be closed. Usually on shortened holiday weeks, it's less volatile, but with the way the market's been going with all the bipolar tariff news, I believe that the market volatility is here to stay. So just a heads up that Friday we will be closed, but I don't think that the volatility will go away anytime soon. Okay, so let's go back to what we talked about last Sunday. Basically, a brief synopsis from last week was that I was very confident that a near-term market bottom would be formed and that the market would rally higher. I outlined a specific support area that I believe the market would bounce at, and that's exactly what had happened. So a few hours after I posted last week's video, the market reopened and the cash index for the S&P 500 came right down to test that critical support level. So I'm going to go ahead and draw it. It was a retest of the 2022 highs, which also lined up with the trend line stemming from the COVID-19 pandemic lows back in 2020. So let's pan over. So you mark the 2020 lows and then you attach it to the 2022 lows, and what you get is a general area from the 2022 highs down to that critical trendline support stemming from 2020 lows is where I believe the market would bounce, as I mentioned in the last week's video. And on top of that, I also posted it. This was upon reopen last Sunday, right at 6:05 p.m. Eastern Time, 5 minutes after the market had opened. I said S&P cash index hit the 4,800 level, which I believe to be critical support, getting ready to do something with the futures. And I ended up outlining how I played it to the Academy members. But here's the picture upon the reopen, and you could see that it was right down in that general area. And looking back on it, that exactly did act as support as noted. Okay, so what I mentioned last week was something called the Trump put, right? I quoted Tom Essay just to bring that back into your guys' memory. I'm going to go ahead and read it again. Again, this is from Tom Essay. He said, the Trump put still exists. This current market calamity is very different from two recent ones, including the pandemic and the financial crisis, in that it's manufactured by government policy. President Trump initiated these tariffs with the stroke of a pen, and he can reverse them with that same pen or via a post on Truth Social, which is exactly what we saw last week. This is not some existential crisis we can't solve, and if it's a policy error, it can be corrected. To that point, the Trump put still exists, although it may be lurking with the S&P down 20 or 25% year to date. Not a great outcome, but it still exists. So he nailed that. Being that Trump put 20 to 25% is exactly what occurred, right? If we take the measurement tool from the all-time highs from February, right, year-to-date highs, down to the lows, it lines up with 21.87% from the highs. So now that we know where Trump's pain threshold or Trump's put level is, it can give us a nice edge going forward. Okay, what do I mean by that? Anytime the market revisits that general area from that 4,800 down to that COVID-19, 2020 low trend line, we can assume that that is where Trump gets very sensitive with his overall plan, and that's where he kind of takes a step back from tariff policy and puts out some bullish news. Okay, so now that we know for sure where that is, again, it gives us a little bit of an edge going forward where we can kind of be one step ahead of the crowd and look at price action down there to come up with an overall plan to buy the dip once price revisits that general area. Okay, so the first test down there is always the highest probability in terms of bouncing. And each subsequent test down there will lose some of its integrity, but it still gives us an overall general area as to when to believe that some policy change is coming. Okay, so again, the market bounced exactly where I anticipated it to, and we did in fact get that market rally, okay, which I believe to be very, very likely. And I talked about last week, this is a quote from Adam Crisafulli. He said, "The velocity of the recent slump is unsustainable, and so it wouldn't be shocking to see a rebound, perhaps even a violent one." And that's exactly what we saw. Wednesday, when Trump came out and posted that there was going to be a 90-day delay on reciprocal tariffs, the NASDAQ had its second best daily return ever, right, since inception, where it rallied as much as 12% in a single day, which is crazy. So again, the volatility, in my opinion, is here to stay, okay? So the price action on Wednesday shows how eager this market is for any sign of reduced trade tensions. Trump can post a new trade deal anytime the S&P re-enters his sensitive pain threshold levels, which is beyond 20% from the year-to-date highs, as I just went over. So, again, this is very, very important to note because it gives us a general idea of where he becomes much more sensitive, okay? Now, that doesn't mean that it's going to bounce there every single time. It just gives us a little bit of an edge in case it does pull back to that general area, okay? And the tariff news has been very, very, very bipolar, as I said. This came out on Friday. This was posted on X. I just screenshotted it. But this came out on Friday saying that Trump exempts phones, computers, chips from reciprocal tariffs, which is a very, very bullish thing for a lot of the Mag 7 names, right? Your Apple, your Nvidia, right? These are all bullish, names that are going to be benefiting from this news. However, about an hour ago, he went on Truth Social and posted that there are no such exceptions. So it's all over the place, right? So rather than rely on the news, I'm a big believer in the fact that price precedes news, meaning it's very, very important. It's more important to come up with general areas based on historical price action, just as I did with this 48.19 level, and kind of gauge price around those general areas in hopes that the news will come after these key areas get tested, okay? So rather than relying on the news itself, which can be very, very bipolar and in plain English, you have no idea when these pieces of news comes out, it's better to have a general idea of some critical areas on technical charts that you can basically front run potential news pieces. So going forward, if the market continues higher, I don't think that it's going to sustain value, okay? First off, I posted this price level in the Discord on, when was that? On Wednesday. I said the critical area to the upside, this is after the reciprocal, the 90-day tariff pause came out and we had that massive move off that level. I said the next critical area to the upside lines up with ES 5525, which represents the 50% fib of year-to-date highs and the lows. Very, very key area if the bulls continue to push higher. So 5525, you could see that that's exactly where sellers reloaded. Okay, if I draw the 50% from the year-to-date highs to lows, go to a 1-hour chart, you could see exactly that is where sellers stepped in. So going forward, I think that's going to be a very, very important area to gauge if price gets back up there, right? If Trump didn't come out and an hour ago and say that there was no such exceptions, and that Bloomberg screenshot that I just had up here was legit, I would have definitely I could have came on here and say I believe that the market is going to gap up 150 handles on the S&P upon the reopen that's about to occur in 45 minutes. But the fact that he came out and said that there's no such exceptions, it's tough to really gauge. So again, instead of relying on the news to tell you where the market's going to head, it's going to be very important to outline these key areas that I'm going over with you guys and gauge price action around them, because the way that price reacts around these key areas is going to be the telltale as to what type of news is likely to follow. So for the bulls, you want to see that price can break above 5525 on the S&P 500 futures and sustain value over that. If it does, the next area above that is this, okay? It's the 50-day and the 200-day, which is about to do what's called a deadly cross, right? A golden cross, which is perceived as bullish, is when the 50-day moving average crosses above the 200-day moving average, right? Something that looks like this, right? When the 50-day, which is the blue line, crosses above the 200-day, which is the purple line, okay? That's perceived as bullish, where going forward, once that occurs, that turns into a buy the dip scenario, usually, okay? You could see the last deadly cross we got was back in 2022, where we did, in fact, rally despite the deadly cross. Okay, so by no means, just because we get a deadly cross doesn't mean the market can't rally. However, what it does imply is that it's higher probability to sell the rallies in a deadly cross environment. Okay, so with the upcoming deadly cross that we are seeing, right, the only way that this does not happen is if the market really starts going to the upside. But because we're in an environment that I believe that, you should start to sell the rallies in, especially with this deadly cross occurring, that is a general area that I believe is going to be solid resistance, okay? That is what I'm getting at. Call it 5,700 to 5,800 on the S&P futures, specifically around that 5,760 area, okay? So I believe that that is going to be very critical resistance going forward, and I would be more comfortable selling the rally up there as opposed to chasing the rally if that area gets tested. So again, from Adam Crisafulli, he agrees with my belief that instead of, if that area gets tested, instead of chasing the rally, it is a higher probability to sell the rally. And I'm going to go ahead and quote him right here. He gives a few different reasons that back up his methodology as to why you should sell the rally, and that any rallies should not sustain going forward. So here we go. Continued volatility and uncertainty on tariff policy. That's one. The significant tariff burden that remains in place, the alarming deterioration in the U.S.-China relationship, the disconcerting rise in long-end treasury yields coupled with the dollar index weakness at a time of substantial macro tumult, right, which is a sign of money potentially exiting U.S. assets given an erosion of confidence. So I wanted to talk about this point right here, right? Bonds have been getting sold, okay? Excuse me. Whether by choice or forcefully, and quite likely the cash was being used either to meet margin calls, buy gold, or move to other currencies and assets. So again, Adam Crisafulli says that the rise in treasury yields combined with the dollar index weakness is a sign of money potentially exiting U.S. assets given an erosion of confidence. Okay, so I talked about this last week, talking about how Trump has been very, very vocal when it comes to getting yields to move lower, okay, because he has to, refinance a lot of debt, and it is his main goal to lower those yields so that when he refinances the debt, it's going to cost the United States a lot less money. Okay, so again, he's been very, very, very vocal on getting the yields down. It has been one of his, main goals, and you could see that this 10-year yield has went absolutely parabolic last week. So it has been doing the complete opposite of what Donald Trump wants to see. And this makes what he wants to do, it makes his plan very, very, very difficult. So it's putting him in between a rock and a hard place. And like, again, it makes his plan very, very difficult to accomplish when you have yields, really, really, really moving to the upside. Okay, so I believe that, looking at the yields, right, ticker symbol TNX, or you could look at US 10Y is another one on TradingView. It'll show you the same exact thing, or very, very similar price action. Basically, the higher this thing goes, the more pressure it will put on the stock market, in plain English. So if this thing gets up to that 480 level, 4.8%, which it was at in the beginning of the year, as of January 14th of this year, if it gets back up there, Trump will be, it'll essentially force Trump's hand to take a step back from a lot of the strict tariff policies. Okay, so if and when the yields get further or move further to the upside, you'll see that Trump gets way more lenient with his tariff exemptions. Okay, and basically this will give you a price precedes news type of edge, where if it gets much higher, you can kind of try your best to coincide that price action with an area of support on the S&P to kind of give you a general idea of when these headlines might come out. So that's my ultimate goal. So Trump does not want this thing getting towards 4.8, and if it does, look out for more lenient tariff exemptions is all I have to say. Okay, so let's talk about a worst case scenario. So again, best case scenario, this thing rallies up to the 50 and the 200-day moving average, where I believe that is where you would have to sell, right? Could it withstand that and go higher? Yes, of course, right? I can't rule that I can't rule that to not be a possibility. However, again, I put my money where my mouth is. That's an area that I would be looking to sell, okay? That I think that the probabilities are much higher to sell there as opposed to chase the rally for more upside potential, okay? Let's just say we don't get up there and the market starts to, come back down and roll over back down to that 4,800, okay? I would expect the market to bounce there yet again. However, if the market does not bounce in this general area again, the next level to the downside would be the weekly 200 MA, which lines up with 4678 at the time of me making this video on the cash index for the S&P. You could look at SPX and NDX as well, right? SPX again lines up with 4679 on SPX. Okay, that 200 weekly moving average. And then NDX lines up with 15,744. Again, all I'm outlining this is for if the worst case scenario occurs where this general area does not provide support going forward. I would expect it to, but if it does not, those 200 weekly moving average lines are the next areas to the downside. So again, I would expect for this general area that Trump put, which lines up with 20 to 25% lower from the all-time highs or the year-to-date highs, I would expect that area does act as solid support going forward. But if it doesn't, the 200 weekly moving average is the next level down. And if the market does manage to rally up towards that 50 and 200-day moving average, I would be more of a seller up there as opposed to chasing the rally higher. So that's it for me. Again, Friday, no market, right? That the markets close on Friday due to Good Friday, which is a holiday event. And these are the key areas that I will be looking at, as well as looking at the 10-year yield. Again, Trump does not want that thing to go higher, and if it does, it'll force his hand to kind of take a step back from a lot of these tariff, strict tariff policies. So hopefully this video was helpful. Again, I appreciate all your guys' support. Every 1,000 subscribers I get, every whole number, so like 1,000, 2,000, 3,000. So the next one would be 5,000. I hop on and do a live webinar on YouTube where I do kind of like a Q&A. So when I hit 5,000 subs, I'll get on there again, and then 6,000 subs, the same thing. So it's something to look forward to as this channel continues to grow. And I always appreciate everyone's feedback. So please continue to do so. It's very appreciative. And that's it. Hopefully you guys enjoy this video. Peace.